The single most expensive day of your life is not the day you pay for your spouse's funeral. It is the day the Internal Revenue Service realizes you are alone. Most Americans spend their entire lives believing that the government will give them a break when they are grieving, but the United States tax code is programmed to do the exact opposite. While you are mourning the love of your life, a mathematical guillotine is dropping on your retirement nest egg. Your household income is about to drop by thousands of dollars, yet your tax bill is about to double, triple, or even quadruple. This is the widow's penalty, and it is a cold-blooded trap designed to take the most from you when you have the least strength to fight back. Tonight, I am going to show you the 4 specific assets you must move right now, while both of you are still healthy, to defang this penalty forever and ensure the person you love is never forced to choose between their grief and their home. Last Tuesday, I sat right here on this porch with my neighbor Jim. Jim is 75 years old, and he lost his wife Martha about 11 months ago. For the first time in a year, the fog of grief was finally starting to lift for him. He was learning how to make coffee for one. But then, he went to see his accountant. Jim came over to my house with his hands shaking, holding a yellow legal pad. He looked at me and said, "I lost Martha's Social Security check, so I have less money coming in. But my accountant says I owe twice as much in taxes this year. How can I be poorer and pay more at the same time?" I had to look my friend in the eye and tell him the hard truth. The moment Martha passed, the Internal Revenue Service stopped seeing him as a grieving husband and started seeing him as a single filer. That one change is costing him a fortune he cannot afford to lose. Here is the cold reality of the tax code. When you are married, you get a wide, comfortable tax bracket and a $30,000 standard deduction. But the moment you are a widow, that deduction is sliced in half. You lose one Social Security income, but the government's required minimum distributions from your traditional accounts do not care that you are alone. They force the money out and push you into a higher tax bracket as a single person. You are being penalized for surviving. It is a mathematical trap that triggers the second the funeral is over. If you do not restructure your assets, while you are both still filing jointly, the survivor will spend the rest of their life sending their late partner's hard-earned savings to the federal government instead of keeping it for the family. To protect the person you love, you must take action on these 4 specific assets, while both of you are still alive and healthy. Think of this as building a financial fortress around your home. First, you must address your traditional IRA and 401k accounts. These are tax time bombs. Every dollar inside is a debt you owe the government. You should start aggressive Roth conversions right now. By paying the tax today at the wider tax rates available to married couples, you transform that growing debt into a tax-free legacy. When one of you passes, the survivor inherits a Roth account that provides tax-free income for life. Second, look at your taxable brokerage accounts. Most couples own these as joint tenants, but that can be a costly mistake. Depending on your state, the survivor may only get a step up in basis on half the account, leaving the other half exposed to heavy taxes. You must review your titling. Use a community property agreement or a joint revocable trust to ensure the survivor gets a 100% step up in basis. This allows them to sell the entire portfolio without paying a single penny in capital gains tax. Third, evaluate your pension. Many people choose the highest monthly check, known as the single life option. But that check disappears the moment you die, leaving your spouse with nothing. If you haven't started your pension, choose the survivor benefit option. If you are already locked in, consider a pension max strategy. This involves using life insurance to create a tax-free death benefit that replaces the lost pension income for the survivor. Finally, restructure your bank certificates of deposit and taxable bonds. The interest from these accounts is taxed as ordinary income and can push a widow into a higher Medicare premium tier, known as IRMAA. Move these liquid assets into high-quality municipal bonds or tax-deferred annuities. This keeps the income invisible to the taxman and ensures that the survivor's monthly budget remains stable. Doing this work today is the most practical and profound way to say, "I love you." The Internal Revenue Service is patient. They are waiting for the calendar to turn and for the funeral home to call. Do not let them be the primary beneficiary of your life's work. Sit down with your spouse tonight. Open the books. Talk about the day after, while you still have the power to change the outcome. If this message woke you up, please subscribe and share it with another couple you care about. We build our legacy one wise decision at a time. I am the Silver Porch. Stay sharp, stay wise, and protect the ones you love.